Hi everyone, so in this video I'm gonna run through the 2025 higher level question 1B on company final accounts. So I've set up my trading profit and loss and my balance sheet here at the very start like you normally would. So here's the trading profit and loss here. And this is my balance sheet. So if you're not sure how to do that, I'll just link a video down in the description that'll show you how we should set that up. So that's how you should set up at the very start of any company final accounts question. So that should take you about 8 or 9 minutes once you've practiced that a good few times. So that's step one. So step two then that we're going to do is to just transfer everything from our trial balance into our accounts. So if we start here, so just starting reading from the top. So Cahill Limited has an authorised capital of 1.7 million divided into 1.2 million ordinary shares of €1 each and 500,000 4% preference shares of €1 each. The following trial balance was extracted on 31st of the 12th, 2024. Okay. So we're just gonna bring these couple numbers in here first. So it's gonna be ordinary shares of €1 each. So under my share capital heading here, I'm gonna put ordinary shares at €1 each. And that's 1.2 million. So that's for my authorized. So under my authorized heading, 1,200,000. Then we've got 4% preference shares at €1 each. 4% preference shares at €1 each. 500,000 of those. Okay. Put a line under there. And I can double underline here once I get that total. So that's going to be 1,700,000 there. Okay. Next then we've got land and buildings, 1.3 million. So that's a tangible fixed asset. So land and buildings, and it's in at 1,300,000. Then we've got provision for depreciation on buildings. So I'll just open up another bracket here halfway. 150,000. Okay, so this is the way I'd recommend doing all the workings, just on the face of the accounts within brackets. So it's just going to save you a lot of time then flicking over and back pages if you're doing workings on separate pages. So we'll keep going down through it this way. So delivery vans, tangible fixed asset, so vans, and cost is 290. Then the 210 here is the net book value. So the depreciation, accumulated depreciation, is going to be the difference between those two. So cost of 290 and net book value of 210. Accumulated depreciation must be 80. Patents are an intangible asset. Pop that in there for 30,600. Then we've got investments, financial asset. So 3%. Investments. We wouldn't have any adjustment to that 160 figure there, so I'm just going to pop that straight over to the third column here. Okay. Then we've got debentures, so that is a creditor falling due after 1 year. So 6% debentures. Again, wouldn't expect any adjustment to that, so 240 into the third column. Okay. Debtors and creditors, so current asset obviously for debtors, 104,200. Creditors is a creditor falling due within 1 year, 88,500. Okay. Then we've got opening stock, 82,600. So that goes into my cost of sales. Wouldn't expect an adjustment there. 82,600. Purchases, cost of sales, 1440000. Sales 1860. Okay. Discount on the credit side, add operating income. So if that was on the debit side, it'd be up in selling and distribution, but it's on the credit side here. P&L balance 43,400. So that's on the debit side, meaning that's a loss brought forward. So here by P&L balance 1st of the 1st, 2024, I'll pop that straight into column 3, and it's going to be minus 43,400, okay? On the credit side, it'd be a positive figure, but debit side is a loss brought forward, so that's a negative figure. Dividends paid, 26,000. Okay. That's down here. So provision for bad debts goes underneath my debtors. So I'm going to put less BDP, short for bad debt provision, 5,300. Salaries and general expenses, that's an admin expense. So that is 225,500. Issued capital, so that's going to be down in my share capital section. So 800,000 for ordinary shares under my issued column here in the middle. 450 for preference shares. Total on those is going to be 1,250,000. Advertising is selling and distribution. Uh, 24,000. Director's fees, that is in admin, for 45,000. VAT on the credit side, so creditor falling due within 1 year. On the debit side, it'd be current asset, but here it is on the credit side. Bank on the credit side, so that's a bank overdraft. So creditors within 1 year, 32,000. PEY, PRSI and USC, again on the credit side, so creditor within 1 year. 24,600. Okay. Debenture interest for the first 9 months, so that's debenture interest paid. So that's going to affect my debenture interest due at the end of the year. So that's going to go in. I'm going to start working here for debenture interest due. That's going to reduce that figure. So whatever we paid is going to reduce how much is due at the end of the year. So I'm going to put it in as minus 10,000 there. And finally, capital reserve, 20,000. Okay, so that's down there in the share capital section. So that's all those gone through. Sorry, almost missed a step. So we'll just work out the investment income and debenture interest now as well to go into the P&L. So I'll start with the investment income. So 160,000 worth of investments times 3%. Acquired on 1st of July 24, accounts for year end December 24, so that's 6 months. So times 6 over 12. See what I'm getting for that. 2,400. Pop that in here. Debenture interest in. Oh yeah, I'll just start working here as well for investment income due. So 2,400 of what's in the P&L, just put it in as a positive figure, and then later we'll take away however much we've actually received, and what's left over is going to be a current asset then. So we'll finish off that working later. Debenture interest now. So I'll open up a bracket here. Okay, 6% debentures, including 80,000 issued on 1st of April 2024. So we've got 240 at the end of the year. But for the first 3 months of the year, we only had 240 minus 80, so 160. So if I go 160 times 6%, and that was for January, February, March. So multiply that by 3 over 12. And then plus 240 we had for the rest of the year, times 6%, and that's times 9 over 12. So I'll see what I'm getting there. So if I take 160 times 6% times 3 over 12, and plus 240 times 6% times 9 over 12. Sorry, just do that again. So 160 times 6%, 3 over 12. So I get 2,400 plus 240 times 6% times 9 over 12. 13,200 altogether. So just put that in as a minus figure there because that is an expense, obviously. So income goes in, investment income, positive figure, but debenture interest minus figure. And similar to the investment income, I'm just going to go to my debenture interest due working, and I'm going to add on the 13,200 there of the expense. So it's going to be the expense minus what was paid is going to give us whatever is left over, is going to give us a debenture interest due to go into my creditors within 1 year. But this 10,000 might change later in the workings in the additional information. So I'm just going to not going to close out the working just yet. Okay. So that's first 3 steps done. Set up our accounts, transferred everything in from the trial balance, worked out the investment income and debenture interest. Okay, so step 4 now is to look at my adjustments here. Okay, so first one, stock at cost on 31st of the 12th 2024 was 86,200. Okay, so if I go, that's going to be my closing stock, because that's stock at the very end of the year. So if I go to less closing stock in my cost of sales, open up a bracket, and we're starting off with 86,200. This figure includes stock at cost of 5,200, which was later damaged and now has a net realizable value of 2,400. So we have to value stock at the lower of cost and net realizable value. So very simply take out the cost and add back the net realizable value, because the net realizable value is lower now than the cost. Okay. Next one, patents incorporating 4 months investment income are being written off over a 5-year period which commenced in 2023. Okay, so there's 4 months investment income included within patents, but it shouldn't be included within patents. That doesn't make any sense. So we need to get that investment income out of patents and into where it should be first of all. Okay, so the way it always comes up, it's always to do with investment income being within patents, really, when this adjustment comes up. And we have to assume that this is investment income received, because if you look back through the marking schemes, when this comes up, this is always the figure for how much investment income we actually received during the year. So when we receive investment income, what would generally happen is we're going to get the money into the bank. So we're going to debit bank, and then the other credit should be going to our investment income due, because it's going to reduce the amount of investment income that we're due at the end of the year. And investment income due is an asset. You can see here it's under current assets. And if we credit an asset, we're going to reduce that asset. So that's where it should be, but it's within patents. It was actually credited to patents. So it reduced patents, because patents is also an asset. So basically what we need to do is we need to add it back to get it out of there. So it would have reduced the patents first of all. So now we need to add it back on to get it out of patents, okay? So that's why it's going to be plus if you see it in the marking scheme here instead of minus. So it's plus, and then we'll work out whatever 4 months investment income is. So If we look at our investments again, so it's 160,000 times 3%, and then times 4 months is 4 over 12. Okay, so let's see what I'm getting for that. So 160 times 3% times 4 over 12, 1,600. So we have to add back 1,600 to our patents there. And then that 1,600 should really be reducing our investment income due, okay? So it's going to be minus 1,600 down here then. Okay. So that's that adjusted for to do with the investment income being within the patents. Now we just need to do the write-off part. So when we write off patents, that's going to be an admin expense. So I'm going to go to patent, written off. And I just need to take the correct amount for the patents. So it's the 30,600 plus the 1,600 we added back. So that's 32,200. And then we're being written off over 5 years, which commenced in 2023. So 2023 was the first year of write-off. And now we need to do the write-off for 2024. So there's 1 year gone, because last year was the first year. So there's 4 years of write-off left. So it's going to be 32,200 divided by 4. See what that gives me. 8,050 in my admin expenses for that. And that's going to reduce the final value of our patents in the balance sheet. So I need to go minus 8,050 here. Let's check my final figure there. So 32,200 minus 8,050, 24,150. I can put into my third column here. Okay. So that's the first two done. Okay, next one. Provide for depreciation on delivery vans at the annual rate of 15% of cost from the date of purchase to the date of sale. Note, on 31st of May 2024, a delivery van which had cost 46,000 on 30th of September 2021 was traded in against a new van which cost 60,000. An allowance of 23,000 was given on the old van. The check for the net amount of this transaction was entered in the bank account, but was incorrectly treated as a purchase of trading stock. Note, these were the only entries made in the books. Okay, so the first thing I'm going to do here is just fix the purchases, okay? So it says the check for the net amount of this transaction was entered in the bank account, but was incorrectly treated as a purchase of trading stock. So the net amount of the transaction is going to be the cost of the new van. So the cost of the new van was 60,000. And they give us an allowance on the old van when we traded it in of 23,000. Okay, so the net amount is 60 minus 23, which is 37. And that was incorrectly treated as a purchase of trading stock. So I'm just going to take that out of purchases. So I'm just going to go minus 37,000 from purchases there. Okay. Then I'm going to fix the cost account. So if I go to my van's cost here, I'm starting off with 290 from my trial balance. We need to take out the cost of the old van. So the old van had cost 46,000 when it was bought. So we need to go minus 46,000 here. Then we need to add on the cost of the new van, which is 60,000. See what that gives me. 290 minus 46 plus 60, 304,000. Cost for vans. Okay. Next we need to do the depreciation for the year. Okay. So if I go to depreciation on delivery vans, we'll go to my selling and distribution costs, because delivery vans are used to distribute our products. So that's why it's in under selling and distribution costs. So depreciation on delivery vans. Okay. So provide for depreciation on delivery vans at the annual rate of 15% of cost from the date of purchase to the date of sale. So basically we just need to split it up into 2 periods. So 290 was our cost from the trial balance. So, and we didn't take account at all of this situation that happened here in this note. So the 290 was our correct cost up until we had this trade-in and where we bought the new van on the 31st of May. So 290 was our cost for the first 5 months of the year. So if I go 290,000 and it's 15% per year, and 290 was our cost for the first 5 months of the year up until the 31st of May. So multiplied by 5 over 12. Plus, what was our cost for the rest of the year? Well, it was the 304,000 that we just calculated. So after this trade-in, our new cost became that 304,000 there. So then I need to go 304,000 times 15%. And that's for the rest of the year. So that's times 7 over 12 then. Just get a total on that. So that's 44,725 depreciation for the year there. And that's going to get added on to my accumulated depreciation from my vans in the balance sheet. So I've got 80 starting off. And now I need to add on 44,725. Okay. Next thing now is to just work out the profit or loss on the sale of the old van. Okay. So this is probably the only one where I'd go off and do a working on a separate page, because you just need to check if you made a profit or loss when you got rid of the old van. And if you work out that it's a loss, that's going to go under selling and distribution costs, because the loss is an expense. And then if you made a profit, it's going to go under your ad operating income. So you just need to work out first if it's profit or loss, so you know where to put it. Okay. So working one, profit or loss on disposal. Okay. So to work this out, you're going to need to look at what was the cost. You're going to need to work out the accumulated depreciation on that van. This minus this will give you a net book value. We'll compare that to the allowance then that we got. And then if once we compare this to this, then we're going to see if we made a profit or loss. Okay. So what was the cost originally? So it was 46,000. Now we need to work out the accumulated depreciation. Okay. So it's going to be 46,000 times 15%. Now we just need to work out how many months that we actually had it. So for 2021, so we bought the van in 2021, okay, and sold it on 30th of September 2021. We bought the van and we sold it on 31st of May 2024. So in 2021 we had it, so we bought on at the end of the month, so just don't count September, okay. So we had it for October, November, December in 2021. So that's 3 months. We had it for all of 2022. So that's 12 months. All of 2023. So another 12 months. And the first 5 months of 24. So just see how many months that is. So 3 plus 12 plus 12 plus 5. 32 months. Okay. So we multiply by 32 over 12. And that'll give us the correct accumulated depreciation then. See what I get there. 18,400. Okay, what's 46 minus 86,400? So 27,600 is the net book value when we traded it in. What was the allowance? It was 23,000. So that's a loss. So we're valuing it at 27,600, but they only gave us 23,000 off the cost of the new van. So that's a loss of 4,600. So that's going to go under my selling and distribution costs. So loss on disposal of van. Put working one in brackets just to tell the examiner where to find where you work this figure out. And it's 4,600. Okay. Very last thing we need to do then is we just need to take the accumulated depreciation on that was there on the old van out of our accumulated depreciation in the balance sheet, because if we don't own the van anymore, we shouldn't be accounting still for the accumulated depreciation. So I'm just going to go to my accumulated depreciation working here and go minus 18,400 from here. Okay. So I'll get the final figure there. So 80 plus 44,725 minus 18,400. 106,325 for my accumulated depreciation there. And 304,000 was my cost. So 197,675 is my net book value for delivery vans. So that's the third one done. Okay, let's keep going now. A debtor who owed Cahill Limited 22,000 sent a check for 21,600 as an agreed settlement of the debt. No entry was made in the books in respect of this transaction. Okay, so there was a debtor who owed Cahill Limited 22,000 and they sent a check for 21,600 as an agreed settlement of the debt. So we're going to need to reduce our debtors by the full amount of what was in there as a debtor, so 22,000. Okay, so reduce our debtors by that much. They sent us a check for 21,600. Okay, so that's going to be a debit to our bank. But our bank is there as a bank overdraft here of 32,000. So if we got 21,600, that's going to reduce our overdraft then. So we're going to go minus 21,600 here. Then there's 400 left over. And then this was an agreed settlement of the debt. So since it says it's an agreed settlement, then essentially what happened is we gave them a discount. Okay, so we gave them a discount of 400. Now our discount started off on the credit side, so 11,700. So that's our discount net, means we received more discounts than we gave. But this is us giving a discount of 400. So that's gonna reduce our discount here by 400. Okay. Because it started off as like that our discount, we were making more income from our discounts than we were having expenses. But this is an expense in the discount account because it's a discount allowed. So it's going to reduce our discount and our ad operating income there by 400. Okay. Right, next one. The suspense figure arises as a result of the incorrect figure for debenture interest and a VAT payment of 2,000 which was entered on the incorrect side of the VAT account. Both transactions were entered correctly in the bank account. Okay, so we're being told that the figure for debenture interest is incorrect. Okay, so it says here debenture interest for the first 9 months is 10,000, and we're being told that that's incorrect. Okay, so if we work out how much should debenture interest for the first 9 months actually be. Okay, so if we we got 80,000 issued on the 1st of April 2024. Okay, so first we'll look at the first 4 months. Okay, so that's 160,000 we had for the first 4 months. Sorry, the first 3 months, excuse me. So 160,000 times 6% times 3 over 12. Let's see what that is. 2,400. Okay. Then we got the extra 80,000 then on the 1st of April. So that brought us up to 240,000 worth of debentures times 6%. And it's for the first 9 months. So we need another 6 months. So multiply by 6 over 12. And see what that gives us. 240 times 0.06 times 6 over 12. So that's 7,200. So 24 plus 72. So 9,600 is the correct debenture interest figure for the first 9 months. And it's currently in as a debit of 10,000, but it should only be a debit of 9,600. So I need to put 400 on the credit side here, okay? And then if I put 400 on the credit side in my trial balance here, then now all of a sudden these two sides don't balance. And in accounting, our debits and our credit sides always need to balance, okay? So we just need to add 400 onto the account where our suspense is here, okay? So our suspense account is incorporated within the salaries and general expenses. So I put 400 onto the credit side here. Now I just need to add 400 onto the debit side here to balance these up again, okay? So that's how I'm going to get like the correct figures that I need to put into my workings here for this adjustment. Right. And then there was a VAT payment of 2,000, which was entered on the incorrect side of the VAT account. Okay, so if I look at my VAT here, it's on the credit side, 19,200. And a VAT payment is going to be debited to my VAT account. So it's going to reduce the amount of VAT that I owe. And it was a VAT payment of 2,000, but it was entered on the incorrect side. So if I debit it by 2,000, then that's going to bring it back to where it was. So that's going to cancel out the incorrect entry. But I also need to put in that I actually did pay that 2,000 of VAT. So I'm going to need to debit it by another 2,000 there. So that's 4,000 I've added onto the debit side here. So I need to put 4,000 onto the credit side here in my suspense account to balance out my sides again. Okay. So hopefully that makes sense. If you want to check here just to see are your sides balancing up, okay? So we started off with 3,701,300. And I added 400 onto the credit side here and 4,000 onto the credit side here. So that gives me 3,705,700. Okay. And then 3,701,300 I had on the debit side. I added on 4,000 here. And I added on 400 here. So now my sides are still equal there. Okay. So that's the easiest way to get the correct answers for the suspense working. So I'm just going to pop these adjustments now into my accounts, all right? So start off with the debenture interest due. So I had this in as 10,000 originally. So the easiest way is just going to be to cross this out and put in the correct figure. So minus 9,600 there should be the correct figure. So if I take 13,200 minus 9,600, 3,600 is the debenture interest due at the end of the year. Okay. So that's that one done. Then my VAT. So I need to reduce my VAT liability by 4,000. So that's that done. Look at my suspense account now. So I need to increase my, so I had 400 debited to salaries and general expenses. So that's going to increase this by 400. But then I had 4,000 credited. So I need to reduce it by 4,000. Okay. So that's those two put in. Right. That is my suspense adjustment done. During the year, a storeroom, which cost 20,000, and stock, which cost 11,000, were destroyed by fire. The insurance company determined 29,000 as the compensation for the fire damage. No entry had been made in the books in respect of the fire. A new store was built by the firm's own workers. The cost of their labour, 25,000, have been treated as a business expense, and the materials costing 58,000 were taken from the firm's stock. No entry had been made in the books in respect of the new store. Okay, so we'll just go through this again. So during the year, a storeroom which cost 20,000 and stock which cost 11,000 were destroyed by fire. So I'm going to need to reduce my land and buildings by 20,000 because a storeroom is going to be included within land and buildings. So cost of the storeroom is 20,000, so reduce that. And then stock which cost 11,000. So since this says during the year, it's my purchases that I need to reduce by 11,000, okay? Not my closing stock. So if you ever see that something happened to stock, but it happened during the year, then don't touch your closing stock, because during the year means it has no connection to your stock at the end of the year, okay? So just don't adjust your closing stock, adjust your purchases. But if you saw that it was something happening to stock at the very end of the year or on the last date of the year or whatever, something like that, then you would adjust your closing stock, okay? But since this just says during the year, we're just going to adjust our purchases. Okay. The insurance company determined 29,000 as compensation for the fire damage. So that 29,000 is going to go in as a current asset. So it doesn't tell us that they've actually sent us this money yet. So we're going to assume that we haven't received it yet, which means it's like receivable at the end of the year. So I'm just going to put this in as insurance claim receivable under my current assets. And I'll pop that in as 29,000. Okay, 29,000. Now, so the total cost of what was destroyed by the fire was 31,000, so 20 plus 11. They only gave us 29. So that's a loss on insurance claim, which goes into my admin expenses of 2,000. Okay. Now, a new store was built by the firm's own workers. The cost of their labour, 25,000, had been treated as a business expense. Okay, so if the firm's own workers are building a new store, then any cost of that is going to be needs to be capitalized as a fixed asset, so needs to go towards the cost of the new store in your balance sheet. Okay, so 25,000, so we need to add 25,000 onto our land and buildings here, and it was treated as a business expense, so that's going to be within our salaries and general expenses. So we're going to minus 25,000 from there, so it shouldn't be within there, it should be within the land and buildings. And then materials costing 58,000 were taken from the firm's stock. Okay, so that should be another 58,000 added onto my land and buildings. And I'm going to need to take 58,000 away from my purchases. Okay, because again, this is during the year, so it has no connection to the closing stock, so take it away from the purchases. Okay, so that is that one done. Okay, the figure for advertising is for a 12-month campaign, which began on 1st of May 2024. Okay, so the advertising here is 24,000, but that's for 12 months, which began on 1st of May 2024. So only from May to December, from start of May to end of December, is actually relating to this year. So we need to take whatever is not relating to this year, needs to come out of my trading profit or loss. So I'm going to go 24,000 multiplied by May to December. So it's from 1st of May, so that's going to be 8 months. So if I multiply by 8 over 12, then 16,000 is going to actually relate to this year. And the remainder is a prepayment. So that goes into my current assets. So advertising, prepaid. and it's going to be 8,000 going in there. Okay, so that's that one done. No record has been made in the books for goods in transit on 31st of the 12th, 2024. The invoice for these goods had been received from the supplier for 13,776. This included VAT at a rate of 23%. Okay, so we need to increase our creditors by the full amount of the invoice. So I'm going to go to my creditors and add on 13,776. Okay. Then we need to increase our purchases by the amount without the VAT. So to get the amount excluding the VAT, it's going to be 13,776 divided by 123 multiplied by 100. So 11,200. I'm going to need to add on to my purchases. And then since these are in transit at the end of the year, I also need to adjust my closing stock as well as my purchases. So I need to add on 11,200 onto my closing stock as well. All that's left then is to account for the VAT. So the VAT is going to be 13,776, the difference between that and the 11,200. So 2,576 is the VAT. And this is VAT on purchases. So VAT on purchases means that I'm going to debit my VAT account, okay? So if I go here to VAT, this is in a credit position. So a debit is going to reduce this credit position. So I need to go minus 2,576 from here. Okay. So VAT on purchases is always a debit to VAT. If it was VAT on sales, it'd be a credit to VAT, okay? So if you think purchases are an expense, they're on the debit side. So the VAT, you also debit the VAT, okay? But then if it's VAT on sales, sales are an income, they're on the credit side. So the credit would be to VAT, okay? So yeah, that's why it's minus 2,576 here. All right. The directors recommend that provision should be made for both investment income and debenture interest due. So I already closed out my debenture interest working, so I'll just do the same for investment income. So it's 800. It's going to be 800. Provision for bad debts to be adjusted to 5% of debtors. So if I get my final debtors figure, 104,200 minus 22,000, I'll get 82,200 there. My provision should be 5% of that. Yeah, 5%. So 4,110 I need to take away here. So I'll just get the net of those two. So difference between 4,110 and 82,200 is 78,090. Okay. And then I just need to look at if that provision has gone up or down. So it was 5,300, but now it's only 4,110. So 5,300 minus 4,110. That is a decrease in bad debt provision of 1,190. And a decrease in bad debt provision goes to my ad operating income. So an increase would go to selling and distribution, but decrease goes to ad operating income. So decrease in bad debt provision of 1,190. Okay. That's that one done. Okay, I need to depreciate buildings by 2% of cost. So that's going to be an admin expense. So depreciation on buildings. So if I get my cost, so my new cost is on buildings, let's work it out. 1,300,000 minus 20,000 plus 25,000 plus 58,000. 1,363. 1,363,000. So I need to take 1,363,000, but I need to take out whatever amount of that is land. If I go back to my trial balance, I'll find that. So land is 200,000. So 200,000 comes off of that. Multiply that by 2% and I'll see what I get. So 1363 minus 200,000 times 2%, 23,260. Add that onto my accumulated depreciation in the balance sheet. So plus 23,260. That should be 173,260. Get the difference between those two. So 1,189,740. 189,740 there. Okay. So let's see, last one. The managing director should be paid a bonus commission of 3% on all sales in excess of 1.2 million and an additional 4% of all sales in excess of 1.6 million. Okay. So sorry, let's see here again. So let's see what our sales figure is. So sales 1.86 million. So commission. So commission is a selling and distribution expense. Okay, so that's going to be like commission on the sales that they've made. So that means it's a selling cost. So here I'll put commission. Okay, so there's 1.86 million of sales. So 3% is on all sales in excess of 1.2 million up to 1.6 million. So that's 400,000. And that's at 3%. Plus, in excess of 1.6 million, there's 260,000. And that's an additional 4%, so 7% in total on that. Let's see what we get there. $30,200 altogether. We're not told that this has been paid, so we assume that it's yet to be paid at the end of the year. So call this commission payable under my creditors falling due within 1 year. It's 30,200. Okay. So that's all the adjustments gone through. So the only thing that's left to do now is just to tot up our totals. Okay. So I'll just do that now. So sales, no adjustment there. So 1,860,000. Okay, let's tot up our purchases. $1,345,200. And our closing stock. $94,600. So take that away. Let's see what we get there. Oh, and that closing stock also needs to go in as a current asset. So under current assets, closing stock per TPL. And it was for 94,600. Okay, 94,600. Get the total for the cost of sales then. $1,333,200. That gets taken away from my sales to get my gross profit. Gross profit then is 526,800. Get my total for my admin. $95,525. Get a total here for my sorry, that was total for selling and distribution. I'll get the total for the admin now. $196,900. Sorry, that's the total for just this one, for the salaries and general expenses. So $196,900. Director's fees, there was no adjustments, so just 45,000. Okay, now we'll get the total on these. $275,210. Okay. Total of these two, 370,735. Take that away from my gross profit. 156,065. Then my ad operating income, so discount is going to be 11,300. Okay. So 12,490 is my total ad operating income. So 168,555 is my operating profit. Add on my investment income and take off my debenture interest. So we'll get 157,755. No tax in this question. So net profit after tax is the same. Take off my dividends paid for 26,000. Retained profit is 131,755. Take off my loss brought forward. So my P&L balance at the end of the year is 88,355. So I'll bring that across into my, down at the end of my balance sheet. So 88,355 there. Okay, just add up the rest of the balance sheet now. Get a tot on my cost column here for my fixed assets. So 1,667. My accumulated depreciation. 279,585. $138,745 is my total for my net book value. Okay, get a total for my fixed asset section. So 24,150 for my intangible, plus 138,745 for my tangible, plus my financial is 160. So 1,571. So 1,571,565. 1,571,565. Okay. add up my current. So 78,090 plus 800 plus 29 plus 8 plus 94,600 gives me total current assets of 210,490. Get rid of that line, that shouldn't really be there. Now I'll just add up my creditors. Okay, so 102,276. VAT, so 19,200 minus 4,000 minus 2,576, so 12,624. $10,400 is my bank overdraft. No adjustment for the PAYE. Okay. Get a total on these. $183,700. Okay, 183,700, and then my current assets is 210,490. So I've got net current assets of 26,790. Add that onto my total for my fixed assets. So 1571,565 plus 26,790 gives me total net assets of 1,598,355. Then down here, just my capital reserve as well I need to put, so 20,000. So I'll just add these up, so 1250 plus 20 plus the 88,355 gives me 1,358,355. Add on the 240 and I get 1,598,355. Which is the same as my net current assets above. So that's how you know that you've got the question fully right, when your total net assets here is equal to your capital employed down here. Okay, thanks very much everyone. I hope that you found it helpful. So I'll just put that here if you want to take a screenshot of that or anything. So that's the balance sheet. And there is the completed trading profit and loss as well. Okay, so hopefully you found that helpful, and thanks very much for watching.